You've got $100,000, and if you're anything like me, you're looking for an investment that not only grows, but also puts cash in your pocket consistently. That's where JEPI comes in with its income-focused strategy. But wait, what about QQQ? It's a tech-heavy ETF that's all about long-term growth. Which one is the better play for your money? In this video, I'm putting these two ETFs head-to-head. I'll break down JEPI's impressive dividend yield and compare it with QQQ's tech-driven growth strategy to see which one will help your $100,000 thrive. I'll show you their strategies, review their performance, and in the end, I'll show you how much return you can expect from a $100,000 investment over the next 10, 20, and 30 years. Both offer solid returns, but one has the potential to cross a $10 million valuation. Alright, let's break down what each of these ETFs is all about so you can get a better idea of how they align with your investment goals. Starting with JEPI. This ETF is designed to generate consistent income. It does this by investing in large-cap U.S. stocks and using something called an options overlay strategy. More on that later. This strategy works great if you're after regular cash flow, but it could hold back growth if the market takes off. In other words, JEPI is more focused on giving you steady dividends rather than seeing your stock price skyrocket. JEPI's got a solid 7.24% dividend yield, but keep in mind, it's only been around since 2020, so it's very new on the scene compared to other ETFs. Now on to QQQ. If you've ever heard someone rave about riding the tech wave, this ETF is probably why. QQQ focuses on the NASDAQ 100, which means it's jam-packed with the world's biggest tech names. Think Apple, Microsoft, Nvidia. This ETF is all about growth, making it a favorite for those who want to see their investment grow rapidly. In fact, QQQ has a 10-year price return of over 360%. That's some serious growth potential. Now that we've got a sense of what JEPI and QQQ are all about, let's peek under the hood and see what they actually hold in their portfolios. This is where things get interesting because what an ETF holds and how diversified it is can really make a difference in both risk and reward. Starting with JEPI. As an income-focused ETF, JEPI is more balanced across different sectors, but it still leans towards some of the big names in the stock market. Its top sectors include technology at 19.61%, healthcare at 15.89%, and industrials at 13.18%. So, while you get decent exposure to tech, it's not overly concentrated like some other ETFs out there. In terms of individual holdings, JEPI spreads its bets with a total of 138 stocks, with the top 10 making up around 15.21% of the portfolio. You'll see names like Progressive Corp, Trane Technologies, and Southern Company among the top holdings, but no single stock is dominating the portfolio. This setup makes JEPI a relatively well-diversified option which helps to manage risk, especially for investors who want a little bit of everything but still crave that juicy dividend yield. But keep in mind, JEPI's use of the option strategy adds another layer of complexity. While it generates extra income, it could limit your upside if the market takes off. So while it's a solid option for risk-averse investors looking for income, you might not see the same explosive growth that you would get with a more aggressive ETF. Now let's talk about QQQ, which is a totally different animal. This ETF is heavily skewed toward technology, making up a staggering 51.35% of the portfolio. And it's no surprise that Apple and Microsoft dominate the top spots with 9.13% and 8.2% of the portfolio respectively. But it's not just tech. QQQ also has exposure to communication and consumer cyclical sectors like Amazon and Tesla. In total, QQQ holds 102 stocks. But get this, The top 10 holdings account for nearly 50% of the portfolio. That's a pretty high concentration in a handful of stocks, which means QQQ's performance is closely tied to how well those big tech names perform. If tech is booming, you'll love the returns. But if the sector takes a hit, you'll feel it. It's the classic case of high risk, high reward. When it comes to diversification, QQQ is definitely more concentrated than JEPI, which distributes its assets across different sectors more evenly. So if you're someone who likes the idea of riding the tech wave, QQQ might suit you perfectly. Now in the end, I'll show you the potential returns from a $100,000 investment over 10, 20, and 30 years from both ETFs. Both perform well, but one could reach a $10 million portfolio valuation. Alright, now that we know what's inside these two ETFs, let's talk strategy. How do they actually manage their money, and what are the risks you should be aware of before jumping in? Let's start with JEPI. As we mentioned earlier, JEPI is about generating income, and it does that by using an options-based strategy. Specifically, JEPI writes covered call options on some of its holdings, which brings in extra cash that's paid out as dividends. Now, this strategy is great for providing consistent income, especially in a sideways or moderately rising market. However, there is a catch. If the market is doing great, JEPI won't capture as much of that upside because the call options cap the potential gains. So what's the risk here? JEPI's strategy works well in stable or slightly rising markets, but in a bull market, you might feel like you're leaving money on the table. And in a downturn, while the dividends might soften the blow, JEPI's underlying stocks could still take a hit. It's not immune to market volatility, just more insulated than a pure growth ETF like QQQ. On the other hand, QQQ takes a more traditional approach by focusing on growth stocks, particularly in the tech sector. The ETF tracks the NASDAQ 100, which is made up of non-financial companies mostly in tech and holds some of the biggest names in the world, like Apple, Microsoft, and Nvidia. The strategy here is simple. Invest in companies with massive growth potential and watch your investment grow over time. But here's the thing, while this growth strategy has worked phenomenally well over the past decade, with QQQ delivering over 360% returns in the last 10 years, it also comes with significant risk. QQQ is heavily concentrated in tech, which is known for being volatile. If the sector is booming, QQQ is unstoppable. But if tech stumbles like it did in early 2022, you'll feel the impact immediately. The ETF's performance is closely tied to the fortunes of a few key players. So the risk here is pretty straightforward. If you're banking on tech to continue dominating, QQQ could deliver stellar results. But if tech goes through a rough patch, you might have to endure some bumps along the way. And unlike JEPI, QQQ doesn't have the cushion of regular dividend income to soften those blows. Now let's talk numbers, because at the end of the day, performance is what matters most, right? Starting with JEPI, this ETF has only been around since 2020, so we don't have a ton of historical data to work with. That being said, in the short time it's been on the market, JEPI has delivered a one-year price return of 5.21%. For an income-focused ETF, that's a respectable return, especially considering it's designed more for steady dividends than for capital appreciation. Over the longer time frame, though, JEPI's 10-year return is just 15.64%, which is modest compared to growth-focused ETFs. One of JEPI's strengths is its 7.24% dividend yield. Investors who rely on that steady income stream find comfort in knowing they're getting a payout. But if you're looking for huge growth, JEPI might not be the superstar you're looking for. Its option strategy does limit the upside, which is why we don't see those flashy returns like we do with QQQ. Speaking of which, QQQ has a much longer track record. QQQ has been in the game since 1999, and it's one of the highest performing ETFs out there when it comes to growth. Over the past 10 years, QQQ has delivered a jaw-dropping 363.45% return. That's more than 3.5 times your initial investment if you had bought it a decade ago. And for the last 1 year alone, QQQ posted a solid 21.95% return, outpacing JEPI by a mile. So why such explosive growth? Well, it's all about the tech. With massive names like Apple, Microsoft, and Nvidia in its top holdings, QQQ has benefited from the tech boom of the last decade. But as we've mentioned, this comes with more volatility. While the returns are stellar, when tech hits a rough patch, QQQ's performance can be shaky. We saw this in early 2022 when tech stocks took a nosedive and QQQ dropped significantly along with them. But again, the recovery was also steep. But is growth alone enough to make QQQ a winner? In the end, we'll show you which ETF will cross a $10 million valuation. Now that you've got a solid understanding of the strategies and performances of both JEPI and QQQ, let's look into what a $100,000 investment in each ETF could potentially grow into. This comparison will give you a clearer picture of how these two ETFs could impact your financial future, taking into account both capital appreciation and dividend income. Let's start with JEPI. This ETF is built for income. It has a current dividend yield of 7.24%, but due to recency bias, let's assume it maintains a 5% yield for the coming years, with a dividend growth of 3%. Additionally, since its inception, it has an average share price appreciation of 2.95%. So what does that mean for your $100,000? After 1 year, your investment would grow to around $107,950. That's not bad, especially since a big part of that return is from JEPI's strong dividend payouts. Fast forward to 10 years and your portfolio could be worth $215,119. That's more than double your initial investment, thanks mostly to reinvested dividends. After 20 years, things start to pick up a little more. You'd be sitting at $463,841. And after 30 years, your portfolio is projected to grow to around $1,002,476. You'd also be earning around $47,079 annually in dividends, or about $3,923 a month. The big question is, can QQQ beat that? Let's find out. Remember, QQQ doesn't focus on dividends as much as JEPI does. In fact, its dividend yield is only 0.58%, but the real magic happens with its 16.57% average share price appreciation. Here's how your $100,000 could perform with QQQ. After 1 year, your portfolio would grow to $117,150. That's a nice jump in just a year, and that's because QQQ is focused on fast-growing tech companies. In 10 years, you're looking at a much bigger number, $481,481. That's almost 5 times your initial investment in just a decade. And if you're in it for the long haul, after 20 years, your portfolio could grow to a massive $2,278,398. And after 30 years, brace yourself, your investment could skyrocket to $10,679,272. Now keep in mind the dividend income here is small, about $9,328 annually or $777 a month, so most of your returns are coming from capital growth, not dividends. So what's the big takeaway? Well, if you're looking for steady, reliable income, JEPI's your guy. It'll give you consistent dividends and moderate growth. But if you're chasing big, long-term gains and you're okay with some ups and downs along the way, QQQ offers the potential for much higher returns thanks to its focus on tech-driven growth. Want to achieve a comfortable monthly retirement income but don't have $100,000? Click the video on the screen to explore REITs that can get the same results with just $10,000.